Okay, now let's look at understanding this data itself, where this is the same way the data will be available for almost every security. When I say a stock, okay, so this is something which we can download from an NSE site or any exchange which will deal with the future transaction. So this can exist for a security, or it can exist even for an index. Index is more like on a Nifty itself. So it's as good as virtually saying I'll buy one unit of Nifty in future at a specific price. It's as good as saying I'll buy one share of Infosys, one unit of Nifty. So one unit of Nifty is nothing but the way the Nifty is computed. Typically, the weighted average of all the share prices of the 50 companies. So it's as good as buying that combination. So though you don't really buy it, it's only the cash settlement at lot of places. As I said, one buy transaction, let's say at 5,000, one sell transaction at 5,100, you are assured of a 100 rupees profit over. So the actual transaction that is happening is you are neither buying a Nifty or neither selling a Nifty, but you are offsetting both of them. One buy is offsetted with one sell. So depending on the price at which you are buying versus the price at which you are selling, the difference is getting created into your account as a profit or a loss. So you can do it on almost everything without really possessing anything. That's the typical derivatives world today. Even if I don't hold Infosys, another simpler way of talking here, even if I don't hold any share of Infosys today, I can enter into the derivatives market. I'll say I'll sell Infosys today at certain price, Infosys future, and after a certain time I can even say for the same date I'll buy Infosys future. Two prices are there. So because I have entered into both the transactions, one buy and one sell, it really does not matter for me to do the settlement on that day, because the settlement is already assured. I'll buy it at this price, I'll sell it at this price. I don't need to have a share of Infosys to sell, or I don't need to buy a share of Infosys from anyone else. Between these two transactions, the settlement happens. So, and I am credited with that money. So, it's another way. Let's say I am visualizing that the oil prices will go up in future. And neither I am a dealer of oil, neither I am a producer of oil, nor a seller of oil. But I would like to make money on the increase in the price of oil. I'll enter into an oil futures contract. Today I'll enter as a buyer. So today the price may be much lesser. After 20 days, I'll enter as a seller for the same maturity date. So what is happening on that maturity date, like 28th August, 28th June here, on that maturity date, I'll have to buy oil at this price, sell oil at this price. I'll not do both of the stuff, because anyhow 1 unit of oil buy, 1 unit of oil sell. So at the max, that gets offsetted. That process is typically called as an offsetting process, where the difference is what is getting credited into my account. So even if I don't have underlying securities, or even if I don't have oil or any commodity with me, I can very well invest in those derivatives markets. My intention may not be at all to buy oil at a lesser price. Some people may have that intention, but many may not. So what the exchanges have done here is to promote many people get into this kind of markets, because the more and more the exchange earns when more and more transactions happen. So they have promoted the concept of cash settlement. So you really don't need to buy any security on that date. Everything is a cash settlement process, right? So in the same case, as I said, let's assume that I don't even have Infosys with me, right? So today I may get into, I'll buy one Infosys future, let's say at 2945. I don't need to pay anything to the exchange today. Only on 28th August, I really have to pay 2945. Today it's the margin, which is the security deposit kind of stuff, so that I don't default. I'll have to deposit a margin, which is a kind of a security deposit, which is like my own account maintained with the exchange. So let's assume 10% of this. So for each thing, there is an algorithm that runs, which will compute that amount. But typically it would be in the range of that 10%. So let's assume that 10%. So 295 is what buyer as well as seller, whether your intention is to buy or intention is to sell on 28th June, all of us will deposit 295 with the exchange, right? So your amount will be 295, my amount will be 295. What the exchange will do is, now let's say after some point you don't even have any price which is more than 2945. So let's assume you are seeing that it is falling and falling. So here you are entering as a buyer. So what are you doing by doing these two transactions? On 28th June, you are buying one share of Infosys, you are selling one share of Infosys. You are buying one share of Infosys at 2945. You are selling one share of Infosys at 29. You are losing 45 rupees. Which means no, you have to do an offset. I mean, exchange automatically does the offsetting also. Let's say you have entered only as a seller here, no buy transaction. So it comes until this day, the settlement day. The settlement day, it's an auto settlement that happens. So the exchange itself places a buy order for you. Whatever the stock price on that day, let's say the 28th June, the stock price is 2500. What the exchange does is, exchange will automatically place one buy order for you at the price on that day. The price on the last day will always be the same as the stock price on that date, because there is no future. The last day, last minute, the spot price and the future price are one and the same, because there is no more future there. So at that price, there is an automatic reverse transaction that happens, which means your account, you are definitely having a benefit of this 445 rupees into your account. Let's say if the stock price on this day is 25, if it is on this day is 32, the same thing, exchange will place a buy. You have placed a sell here. You have placed a sell here. You did not place any buy in the middle. The transaction has to be offsetted. What happens is, on the last minute, all these unclosed transactions, or all these open positions, this is what is called as an open position. All these open positions are typically closed on that day. See, as simple as this, something is getting expired. You have typically bought one FD, right? That FD is expiring, let's say, after 2 years. Probably you have to sell it on that day, then only you will get your money, right? Don't assume this features of auto renewals and all. Auto renewal is nothing but it is sold and again rebought. That is what is auto renewal. So typically anything you are buying, the selling is happening on that day and the cash settlement is happening, right? And so on this day there is an automated reverse transaction. If you make a reverse transaction anywhere in the between, the settlement is done through you. But if you don't make, it is typically squared off by the exchange itself, or your broker itself make it in. Just like any margin trading that happens on a stock. Let's say today I get into some margin trading, that I'll buy something. Okay, I'll show you one. Oh, today is a Saturday. Let's say anything where I deposit some margin and get into some buying process. So I may decide some price for me. So here, in most of the cases, the broker will do, so you see the square off here. The broker will do the square off, which means either you can do the square off, which means you place a reverse transaction. So if you are going into a buy now, you have to place a sell before it actually expires. So in case of the stock margin trading on a stock, typically the time period is 1 day. During the day itself, you have to square it off. So if you are saying buying it at let's say 9 o'clock in the morning or 9:30 in the morning, before 3:30 you have to close the position. Whereas when it is coming into these derivatives, you have 3 months to close the position. Either you may enter as a seller or a buyer, whatever is your role. But you are placing an opposite transaction. And if you are not placing an opposite transaction, the exchange will do that for you. At whatever is the last available price, the exchange will do that transaction for you, which is resulting in that settlement into your account. So depending on whatever is the price on this date, depending on whatever is the price on the last date, your account is updated accordingly. But the advantage is you have the flexibility of settling it off anytime in the middle also, just like a stock market. So which means irrespective of you holding the underlying security, you can very well trade in the derivatives market. Right? Now, okay, how we are seeing, let's say now the next situation is, if at all I already have some shares and I want to protect them, right? I already have some shares and I would like to protect them. So as long as the share price is going up, not a big problem for me. But only when the share price is going down, I am going to lose out in that case, because if the share price is going up because I already hold the shares, own the shares, I will be benefited only. Only if the price goes down, I would like to protect myself. That is where I have to think through some other products where if it is profitable, I'll leave it. Only if it is at a loss, I will get out of it. That is where options will help me out. In an option, as we discussed, there is a scope to back out. In case of future, there is no scope to back out. At the max, I have to place a reverse transaction, right? I can offset the transaction, and based on that offsetting, I'll be guaranteed of a profit or a loss. On 28th June, I'm guaranteed of some profit or a loss depending on how much I have entered into the contract. Now, here itself, let's assume, should I go for a buy or a sell? The price is 2945. I want to get into a futures market. Now I need to have a picture which will tell me for 2945, should I go for a buy or a sell? Anything I can do. If I assume that the stock price will go up, I'll go for a buy. If I think that it will go down, I'll go for a sell. Right? So because the price is at 29, it is priced at 2945. I really have to think which of these two is better. Buying it today at 2866. So now I'm left with two situations. Buy at 2866 today and sell at 2945 on 28th June. One model for me. Or sell at 2866 today and buy at price on that day on 28th June. Both are possible, right? So depending on today, I may buy it at 2866, and I would get in as a seller in the futures market, which will allow me to sell it at 2945 on that date. Now the other scenario is I will sell today at 2866 and I may buy it now. If at all, okay, here I may not do that transaction because I will not be buying it. Okay, price buy at 2945 on 28th June. I can do both the stuff, right? So if I assume today, let's say I don't even hold a share, I will think of buying it at 2945 on that date, right? Today, probably if I want to get rid of in the middle, if I think that the stock price is going to go down even more, only after 2 months there is going to be a rise, I may very well think of selling it off today, use that money somewhere else and get some return out of it. Probably the 2866 deposited somewhere, get 3000 out of that deposit for 2 months, buy it at 2945 itself. I can even still do that. In that case also I am making a profit. See, if I know there is some other opportunity where if I put the 2866, I will get 3000. I will put this 2866, get 3000, buy the share at 2945 on that day. Had I not done this process, I'm not doing anything. I am selling to a, let's say, I will buy that share at 2945 on that day. That's it. I don't have anything else. Whereas if I visualize that there is going to be a fall and a up, I can take an advantage of that situation by getting into a sell process today and a corresponding buy on that day. So that is what I am going to analyze here, depending on how much these two are correlated, right? What is the kind of correlation that is existing between the Infosys spot market and the Infosys futures market? So based on that, I can see whether the Infosys future market is the perfect hedge to the Infosys spot market or not, right? If I just try out this, so for doing this, I'll have to find the correlation or the relationship that is existing between the Infosys returns, Infosys stock returns, and the Infosys future returns. So I'll say stock returns, and I'll also try to compute future returns for these two. So the stock return, I'll take it in absolute number itself because both are the same security. Otherwise, I'll have to take a percentage return. So for the stock return, I'll take it as this number minus this number in a daily based stock return. It's as good as like probably if I had bought it on first day and sold it on the second day, my return would have been minus 16 rupees. I would have lost 16 rupees on that day. Similarly, if I do it for all the days, so for the next day, I'll just drag off this formula. For the next day, there would have been a benefit of 8 rupees. So like this, I am trying to find out for all the days, what is the benefit with respect to the stock. So there is some data not given. So let's eliminate this data. One date, probably the stock market would have been there, whereas the futures market was not. Futures market was existing, but spot market was not existing. So those kind of stuff could be there. That's where the data is not got published. So this one data where the data did not get published, I'll just delete this off so that the calculations have no issues. So in the spot market, I have tried to find out day wise. On some days, there is a huge return on the negative or on the positive side. And whereas on some other days, there was even, so on this day, there was a huge fall. Now I have to see what was the reaction in the futures market. Now in the futures market, I can very well take the return as this price minus the previous day's price. This is what is the futures market return. All right. You see, there's a huge difference. The stock market versus the futures market. Now, this is what is helping me. Based on this, this is what is applicable to any portfolio also. If I want to build a portfolio of two securities, right? Even if I say buying one share of Infosys and buying one share of Wipro, which is nothing but a building a portfolio. So this same concept is applied in terms of a building of a portfolio itself. So once we do this, even the concept of the portfolio management, doing the basic portfolio creation in Excel also will become clear from this process. So I am trying to find out what is the stock return. I want to see whether the Infosys futures can reduce my risk drastically or not. So it means that if I already hold one Infosys shares, can I go into selling of the Infosys futures so that my loss is almost mitigated? So that is where I am trying to see the correlation between the stock returns and the future return. So I will try to find out the correlation between these two returns, where I will use a formula of Excel called correlation equal to correl, where I will give the stock return as one input, comma, the futures returns as another input. Now, the higher the correlation is between any two securities, I have to do an opposite transaction to do a perfect hedging. The lesser the correlation is, I have to do the same transaction. If the correlation between any two securities returns, let's say is negative or close to -1, correlation always lies between +1 and -1. If the correlation is close to -1, I can buy both the securities and they will become perfect hedge. But if the correlation is close to +1, I can do opposite transaction on both the securities. So if I buy one, I sell the other, that will give me a perfect hedge. So the hedging can very well be built depending on whether the correlation is very close to 1 or -1. The more the correlation is close to 1 or -1, we can very well say that that is a perfect hedge to that particular security. Now in this case, I am trying to check that aspect, which is giving me that the correlation is almost 0.96. The correlation between the stock returns and the future return is almost close to 0.968, which means almost 1. So I can, because it is close to +1, I have to do an opposite transaction. So when I go long or buy in the spot market, I'll have to go short or sell in the futures market or vice versa. Then I can reduce my risk drastically. Now, how do I measure that reduction in risk, or how do I measure that risk itself? That is what can very well be obtained through the concept of, this is nothing to do with the futures market or any market. This is with two different securities. So here my securities are, one is Infosys spot, the other is Infosys future. That's it. It has nothing to do with, probably I can say Infosys spot and Wipro spot. I can very well do any combination. Here I am doing the same because there are two different markets, two different prices. I am trying to see the price between the two. Sometimes people may say stock price and the gold price. If let's say the correlation exists, if the correlation between spot price and the gold price, or stock returns and the gold return is positive, +1, close to +1, then either I should buy in the stock market and sell in the gold market, or vice versa. But if I say their correlation is close to -1, either I buy in the both markets or sell in both the markets. That's one yardstick for me. Or if it is nowhere close to -1 or +1, I can do either of the stuff, but it may not bring down my correlation, bring down my risk that drastically. If it is either close to +1 or -1, the risk can be brought down drastically, either by getting into a similar transaction or opposite transaction. But anything away from +1 or -1, I can bring down the risk. The concept of portfolio itself is club one or more securities. Here I am clubbing one stock market with a future market. So I am clubbing one or more securities. Any clubbing will obviously result in a reduction of the risk. Again, as per our English sayings also, don't put all the eggs in one basket. That's the same logic here also for a portfolio. The moment I choose a second, obviously my risk will come down, but probably marginally. Depending on the choice of the security, either if their correlation is close to +1 or -1, I will see that the reduction is drastic. If it is much away from +1 or -1, the reduction of the risk is pretty marginal. That is what we'll see now. At the max, how much I can lose. That is typically observed through a concept of standard deviation. Standard deviation is a very good measure of the risk of the security. So I'll simply take the standard deviation of the stock, and I will also take the standard deviation of the futures, which means individually what could be the loss. If I had invested exclusively in the stock market, right, or if I had invested exclusively in the futures market, what is the difference? So the standard deviation, I'll say STDEVP, which is a formula, the population standard deviation of the stock market returns. Population standard deviation of the stock market returns is telling me some 56, which is means the average fluctuation in the Infosys price in the spot market, average fluctuation from some center, it is fluctuating on a day on an average by 56 rupees, either to the left or to the right. So my risk is to that extent. If on a single day, I may lose 56 rupees also when I go exclusively in the spot market. Similarly, when I go exclusively in the future market, I'll take STDEVP on the future returns. So this is giving me almost the same, 56.76, which means almost, if I choose either exclusive spot market, stock market, or exclusive futures market, there is a good chance of either losing or gaining. As I said, even if you have bought only, as you said, if you had gone only for this transaction, sell, on the last day, the price would have been 3.2 or 2.4. Based on that, you would have gained or lost, right? So that is what is the measure of fluctuation. And the same scenario, if you had bought only in this, even it could have gone up or gone down. But if you had a combination of these two, probably your loss is getting reduced drastically. When you are buying in one market, immediately sell in the other market at regular points in time. Even if you gain, your gain will be limited. Even if you lose, your loss also will be limited. So now, when I say the average return of stock, return on future. Okay. So the return on stock, I'll use a simple average formula equal to average on the stock, which is telling me that per day I'm losing almost 7 rupees on an average, because we have seen that 2.8 it has gone to 2.4. So that is the kind of a loss that is possible. Similarly, on a future market also, the loss is almost 8 rupees. So individually, if I am choosing both the markets, there is a good chance of a risk. Risk is more a measure only through this. We don't bother about the return. The risk is measured through this concept called standard deviation, where the number is around 56 units. Now, my intention is, if I club these two into some portfolio where I buy in one market and sell in the other market, this is what I am calling as a combination. I buy in one market, I sell in the other market. This is creating, if it can reduce this, let's say from 56, the best is 56.49. If it can reduce my risk probably to around close to 0. 0 means no risk. Whatever is the return which I get here, the risk is 0. I will not lose anything. Even if I gain, or I'm assured, I will not use the word I will not lose anything. I'm assured of the amount, whether it could be a profit or it could be a loss, but I'm assured of it. If this risk is 0, risk is more like a fluctuation. If the fluctuation is close to 0 units, I am very much assured of how much I am going to get. Just let's say in case of bank deposit, right? The bank clearly says, or FD, the bank clearly says you will get this much percentage after this date. It's assured. Probably you may be getting lesser or more. We will always think, oh, if I put my money in real estate, I will get 20% return, whereas the FD is giving me only 7% return. That's the typical thought process that goes. But this 7% is assured, but no one is assuring the 20%. We may get there. So that is where the risk. So that risk, if I try to look at the measurement of that risk in units, the standard deviation is a better measure of that risk, which in this case is saying almost 56 units is the risk, which is like average fluctuation is around 56 units from whatever is the center. There is an average fluctuation of 56 units both in the spot market as well as in the futures market. Now, my intention as a risk manager always is to bring that assurance, because let's think of a scenario. The company has invested in some stock, in this Infosys stock itself. It has bought. One sudden day, if the stock price, let's say some XYZ as a company, I had a lot of free cash with me, so I have bought some shares of Infosys. My intention behind buying the shares of Infosys is the share price will go up. Now, let's say after 3 months or 6 months, the share price has gone down drastically because of some problem at Infosys, for which I am not responsible. I am just an external investor, for which I am not responsible. Something going wrong at that place, the stock price has fallen drastically. Now, my company's profits are going up drastically. I am answerable to my investors or whosoever have invested in my company. So that can result in some companies winding off their businesses also. Until a few years back, that was the reason of closure of so many companies also. They have invested in some other company. That company does not, does something else. And because of this company which has invested there is out of the business. Typically, we see at a lot of locations. Let's say you buy some real estate on some outskirts at some price. That land itself is gone. You are losing. Probably you must have bought it at a lesser price, but that property itself does not exist today because of some kind of a political scenario. You are losing, which means there's a huge risk there. So that's where when you really invest in those kind of investments, you expect the returns to be much higher because you are taking a big risk. Now, if I can create some scenario, derivatives are more of a manipulation of all these things. If I can have some kind of an option that in case this land is taken away by the government or by some political parties, I get 30 lakhs assured. In case the land is taken away by some authorities, I get 30 lakhs assured. I am safe. I can very well buy the land. If someone can give me, if at all my land is there, I'll not get anything. But in case the land is taken away, I will get this much amount. At least I am assured that my 30 lakhs is not going away. Either I will have the land or 30 lakhs, nothing less than that. So I am fixing my loss. That is where insurance is working. The concept of insurance, the entire risk management, insurance is a very good product for risk management. You are at least, the more reason why you are taking an insurance for any of the products is even if some loss occurs, you are assured of some kind of a benefit or you are assured of your loss amount. So the uncertainty is getting reduced by getting into this. Derivatives are also one such instrument. Just like insurance, derivatives is another form of an instrument which will reduce your loss. Now, probably for this I can take insurance, but insurance companies may or may not be available or may not be ready to insure this loss. So derivative is a much better tool where this loss can be reduced for me. Now I will look at, because the correlation between these two is very high, I will look at a scenario where I will buy in one market and I will sell in the other market. This is the transaction I would like to see. If I buy in one market and sell in the other market, right, how much is going to be my loss? If I buy in one market and sell in the other market, how much is going to be my loss is what I would like to assess, right? Yeah. So we have used a few formulas here for finding out the returns. First is the difference, then the correlation between the two returns using correlation formula, then individual standard deviations, and individual returns we have just used the average formula. Now I am thinking of reducing any intention of a portfolio manager is to reduce the risk, right? So that reduction of the risk means this number has to come quite drastically to an assured number, right? I mean close to zero. If this number comes more closer to zero, I am looking at this as an assured number. Probably if I say I am depositing my money in a bank, I will neither get more or nor less. Whatever is promised as a part of my FD, I'll just get that money irrespective of what is happening on that date. I'm getting a very fixed number. But in none of these investments, I get like that. Nothing is assured. Depending on what is the stock price on 28th June, I'll get that much amount. It may be a plus or it may be a minus, right? So I am trying to, today itself, I am trying to get into some kind of a transaction which will help me to reduce my risk drastically depending on the moment in the future. I am trying to reduce the risk drastically. So let's say I buy one in the forward market, one in the spot market, and sell in the futures market, right? So any portfolio I get into, okay, let's say I have one spot market and I have one futures market. Let's say I am buying one unit in the spot market and selling one unit in the futures market, right? Now this combination, if I want to find out the risk of this combination, again I have to take the standard deviation of the combo, not of the individual. The way I'll find out the combo is I'll find the variance of the combo, which is whatever is the weightage or whatever is the number of units. So I'm going, let's say, with 1 and 1. Whatever is the number of units. So let me say that this is some W1 and this is some W2, some weightage or some units. So my combination risk will always be like W1 squared, the standard deviation of the first one squared, plus W2 squared, the combination of these two squared, plus 2 into W1 into W2 into the kind of covariance that is existing between the two securities. Covariance is nothing but pairwise variance. So if one is going up, how is the other behaving? That's the measure of covariance. If both are going in the same direction, it shows that the covariance will be positive, just like your correlation, right? Or a simpler way, instead of using the word covariance, I can also say 2 into W1 into W2 into correlation into sigma 1 into sigma 2, which is nothing but the standard deviations of each of them separately. This is what will be the standard deviation of the overall portfolio. This is a very common rule. It again uses a basic mathematical calculations to arrive at this, which is nothing but the weightage. This is just looking like your a plus b whole squared kind of a formula, right? So when I say individually this is W1 sigma 1 and the other one is W2 sigma 2, it almost looks like an a plus b whole squared inside. So this is this squared plus this squared plus 2 into this. But of course, this is getting impacted with an additional term called correlation. 2W1, W2, sigma 1, sigma 2, which is more like this, but getting multiplied with a element of correlation, which actually is a small deviation to your typical a plus b whole squared kind of a form. So even if you have multiple securities, even if you have, let's say, today a portfolio manager, okay, so now using this formula, I would like to see to what extent. So here my W1 is 1 and W2 is minus 1, because I am getting into a cell In the cell, I will put it as minus or vice versa. So one is with a plus and one is with a minus. So when I combine these two things, I would like to see what is the impact, what is my risk now. I'll apply the same formula, the square root of this entire stuff, and see if I combine these two things into a portfolio where one is bought and the other one is sold, what is the kind of risk that is involved in the transaction. If I am able to drastically reduce the risk, I can very well say buying in the spot market and selling in the futures market is always a better way to hedge my risk, right? So let me just try out this scenario. I'll apply the same formula in the Excel sheet, right? So I'll say standard deviation of the portfolio, or I'll say combo. I'm putting a standard deviation of the combo, where, as we said, we'll have to write the formula for that entire stuff, W1 squared, sigma 1 squared and all. So before I write the formula, I'm saying W1, I'll put it as 1. W2, I'll put it as minus 1, so that I can access the things much better. So here, I'll write the formula. First, I'll have to do this calculation. W1 squared, sigma 1 squared, W2 squared, sigma 2 squared plus 2W1 this one. Okay. And after that, I'll put a square root on the top of that. Okay. W1 squared, this is W1. W1 squared into sigma 1 squared is sigma 1 is the stock. So sigma 1 squared plus W2 squared into sigma 2 squared plus 2 into W1 into W2 into correlation into sigma 1 into sigma 2. This is what is the value I am calling it for the combo. This is the number for the combo. On the top of that, I have to put a square root. So this entire thing, I will put a square root on the top of this, which will give me the number as 14. So from 56, the number got drastically reduced. It did not go to 0 still. Probably I have to see what combination can take it to 0 also. That's my next step. But at least if I buy one in the spot market and sell one in the futures market, my risk is still getting reduced from 56 units to 14 units, but it is not going down to 0. I am not getting into a kind of assured scenario. I am getting, okay, the fluctuation is reduced by a drastic extent. Initially, the fluctuation was 56 units, either in the up or in the downward direction. But now I am able to reduce the fluctuation drastically to 14 units. Now I may have to see, using the same combination, can I still reduce it to close to 0? That's my next step. Okay. At least this is reducing my risk, right? So any combination, I mean, you don't need to look at this as exclusive to derivatives. Even if you are trying to, let's say, you already have some Infosys shares. Now you would like to see which is a better combination for Infosys, so that my risk is reduced. You want to reduce your risk. Infosys has fallen drastically, gone up drastically, everything is happening. Now you would like to see what is the good security to combine with Infosys, so that your risk can come down. If that is the kind of scenario you are looking at, you can do a similar analysis, because here it is Infosys and Infosys futures. These are two securities. Probably you may think of Infosys and Wipro. You may even think of Infosys and gold. Anything, the analysis goes the same way, right? You find out the correlation between those two returns, and based on the correlation, you try and find out the individual standard deviations and all. And based on the portfolio or based on the proportion, you try to find out what would be a better combination, right? Whether I should go for doing the same transaction or opposite transaction. Now, the next logic for me is there any way I can bring this number to zero altogether? Is there any way I can bring this number to zero by changing probably this number? Right? I would see, I want to reduce my, now this is my risk. So 56 has gone to 14. But that may not be the area which I am looking at. I want it close to zero. To whatever extent I can, to whatever extent it possible, if it can go down to zero, that is much more acceptable for me. Which is like almost no risk kind of a scenario. Anything that comes is assured for me. Right? That is what is the combination I am looking at. So I would like to see, is it possible to bring down that risk close to zero? So which is as good as probably in a simple terms. I mean, if I have to use a good Excel feature for that, I know that my output cannot be 14. I want my output to be 0. For that, I want to manipulate the input. Instead of taking, let's say, -1, just see, instead of -1, I take -2. The risk has increased. Risk has become 60. Or instead of -2, I make -0.8. The risk has gone to 16. Right? Whereas when it was -1, the risk is at 14. Probably -1.1, the risk is at 15. Right? So sometimes my combination can reduce my risk even more drastically. There is a possibility that some combination can reduce the risk even more drastically. Let's say -0.95. Yeah, you see, -0.95 has reduced my risk slightly better. When it was -1, the risk was almost 14 odd units. But when it was -0.95, which means I buy one share, I sell 0.95 future contracts, which is as good as proportionately if I take it, for every 20 shares which I buy, if I sell 19 future contracts, my risk is the minimum in that situation. Right? So I need to see what best combination can be possible in that extent. So I want to pull out this value. Yeah, it's like a proportion. So I can fix one of them. So for every one share which I buy, how many futures I should sell? Either one of them you can very well fix, right? For every one share which you buy, it says two futures you have to sell. You can take it proportionately. For every 10 shares, 20 futures. Or in this case, 1 and -0.95. For every 20 shares which you are buying, 19 futures you have to sell. I multiply both of them by 20, which will tell me for every 20 shares which I buy, 19 future contracts if I sell. That is the scenario where my risk is the least possible in the combination. So to address that, Excel uses one feature called a what if analysis. In Excel, I use a tool called a what if analysis tool. What if this value has to be minimized close to 0? What if this value has to be minimized close to 0? I want this value to be close to 0. To achieve that, I want to change this value. By changing this value, probably just like now as I did, change it to minus 0.95. Then probably I may say minus 0.9. Now it has gone up. Minus 0.9, it has still gone up. So probably minus 0.92. Just the manual way of doing. Where again it has slightly come down. I need to know what is the exact number where my risk is the minimum possible. That is where I depend on some what if analysis tools of Excel. One tool I can depend on is the tool called goal sync. I know what is my goal. My goal has to be close to 0. My standard deviation should be close to 0. That is my goal. Now, to achieve that goal, may or may not be possible in all the cases. 0 may not be possible in all the cases. But whatever is the best possible is what is the combination we are expecting the system to do for us. So, now let's try to apply that goal sync. You get into the data tab. We'll see it will give us the slightly better combination. You go into the data tab. You must be seeing a what if analysis here. Into that what if analysis, go for a goal seek. Go for a goal seek where it just asks you for a few details. So it has 3 values: set cell, to value, and by changing cell. So you set the cell, which is that combo formula cell. Whatever is this cell, in the set cell, you just point to this cell and say to value 0. And by changing the cell, you point out to this W2 cell. Now, once you say OK, it will do some massaging. Yeah. It says it may not have found a solution, but at least it is giving you the slightly better. So to whatever extent it can be reduced, it has reduced and given you a solution at 13.97. At least you can reduce your risk to 13.97 units by doing this combination. What is the combination? For every 1 unit of the stock of the share, go sell on 0.97 units of the futures. So probably if you want on integer terms, you can bring both of them into integers accordingly. Probably multiply both of them, let's say, with 100. For every 100 shares you are buying, sell almost 97 future contracts. If you sell 97 future contracts here and buy 100 shares, your risk will be the minimum possible in this combination, but it cannot go to 0 with this combination in any case. The risk cannot go to 0 in your case, but at least it can come down to 13.97. That is the least possible risk that is possible in this, and that risk is possible when you are going for 1 share of the security, you are selling 0.97 shares in the derivative market, or probably 100 shares of the stock market, 97.5 shares in the futures market. That is what is going to bring down your risk drastically, though it is not 0, but it is coming down drastically. The intention for any portfolio manager here is to reduce the risk drastically, and even if it is fluctuating, create a scenario where the fluctuation is in a very small range, and this number is typically called as the hedge ratio. For every 1 unit of the stock market deal, buy or sell, you require to enter into 0.97 shares, the opposite transaction in the futures market, which will reduce your risk to a drastic extent. Yeah, hedge ratio. So you want to, here the intention is to mitigate. The mitigation of the risk is nothing but hedging. Reduction of the risk as a term is called as hedging. So when I follow this combination, for every one share, 0.975 in the futures market, it is going to give me a scenario of the least possible risk out of all the possibilities. Because if I change this number from 0.975 to some other number, my risk only will go up, but it will never come down. Probably I can even plot a graph which will say what is my risk in all these conditions. Let's say it's not 0.97. I want to check out, let's say, for possible all different values. Now, as I am putting here, I want to check from, let's say, minus 0.5, minus 0.5, minus 0.55. For all the possibilities, instead of minus 0.975, I want to check out for various possibilities. Let's say something like this. Minus 0.5, minus 0.55, and let's say I want to check for all these. In case this number is replaced with, let's say, minus 0.5 or minus 0.5 or minus 0.6. So for all possible combinations I would like to see, and let's say I want to plot a simple graph seeing how the portfolio risk is changing with the different combinations, right? Which means I want to change one input value here and I want to observe this calculation. This is where the next data analysis tool comes in handy for me, which is called as the data table. Data table is a tool which will give me, what if I change one input value, let's say 0.97 becoming 0.5, 0.6, 0.7, how is my output getting impacted? Now, how do I calculate that? I will list out all possibilities of the inputs in one single location. So I'll simply put minus 0.5, minus 0.55, and after that simply drag it off. Simply drag it off. You'll get all these numbers updated with an incremental of 0.05 with a minus sign. Now what I have to do is one cell up and one cell to the right. Put an equal to and point it to the output which you want to observe. I want to observe the standard deviation of the combo. Right? So I'll point it to that location here. Then I will select this entire stuff. I will select this entire stuff. Then I will go into this what if analysis data table. Depending on whether this data is in a column or in a row like this. Here I have listed as a column. All these values I have put in one single column. So depending on whether the data is put in a column or in a row, I will select either row input or column input. If it is in the form of a column, I will select the column input. And here I will point it to this location because this is the one which I would like to change. This is the one I would like to change with all these possibilities and observe the standard deviation of the combination. Now when you do this, it will tell you that if it is minus 0.5, the risk is almost 29 units. Then it is coming down, 18, 16, 15, 14, 13, and again it is going up. Just try this out. So you can very well see that depending on the combination you are going for, the risk is either going up or coming down. And the minimum risk is occurring at this combination. For every 1 unit in the stock market, go for 0.975 units in the futures market for Infosys. Probably for some other security, it will be something else. Right? Probably if I take an NSE futures versus NSE index, my numbers could be completely different. And sometimes there may be a security, but there may not be a futures market for that security. So I will try to hedge Infosys with probably XYZ futures. Then again, it's like two different securities. The combination or the correlation between them will tell me what is the best combination I have to choose so that my entire risk is getting reduced. Now, probably if I just need to see the graph for this, I'll simply select these two things. I'll select these two things, or I'll select these two things, and I go for insert a line chart. I'll go for an insert of a line chart. Yeah, probably here it is taking, I don't need a plot of these values. So let me do a right click on the data, select data, and I remove the series 1 from here. I remove the series 1 from here, and I switch the row and column. Sorry. So, okay. I require, if I'm seeing, okay, I remove the series 1, that's it. I'll not do anything more. I'll just remove the series 1 from here. And in the horizontal axis here, I'll simply do an editing. Edit here, instead of 1, 2, 3, I'll just point it to these numbers. Minus 0.5 to minus 1.4. So that I'll get my axis much better. Instead of 1, 2, 3, 4 on the axis, I'll get this numbers on the horizontal axis. So now this is showing that this is how my risk is changing. From a certain combination, the risk is coming down, and it has gone completely minimum at this location between, let's say, minus 0.95 and minus 0.1. And from there again it is going up. So if at all these two are the securities I am looking at, the better combination to combine these two securities is 1 unit of Infosys security combined with a 0.975 units in the futures market. The opposite position. If I am buying in the spot market 1 share, it's better to sell 0.975 shares in the futures market and vice versa to make sure that my risk is reduced drastically. See, because we get into the transaction always in the beginning, so we need to be assured that whatever we are getting is more or less assured. So at any point in time, if I want to hedge my risk, I should know that there is an instrument which is more sufficient enough to hedge my risk, which will tell me that in case things are going bad, I can very well hedge it by getting into the futures contract appropriately. This will reduce my risk drastically, which means almost whatever the amount that is going to come, it's more or less assured for me. Right? But of course, here it is still not gone to 0, but people will look at the combination which will take the number close to 0. Right? This itself is a great reduction, almost 75% reduction from 56 coming down to 14, almost a 75% reduction. But still, if it can reduce close to zero, that's a very good combination for me to go for. It's as good as probably investing in a government security or a bank deposit where the risk is almost zero. But if I can create this combination so that, and I still make some profit, the risk becomes almost zero, but still I can make some profit. That is what I'm calling as the arbitrage profit. By almost eliminating the scope of risk, if I can still make some profit, that profit is what I'm calling as an arbitrage profit. So typically in terms of the futures transactions, the main things people will generally look at is what is the correlation between the spot market and the futures market, and based on this I should see what is my good hedge ratio so that my risk comes down drastically. In what combination I have to go with my investment in the spot market versus the futures market, and what combination is a good choice. If I am going with or should I go for one spot and one futures, or one spot and 0.95 futures, or what is the combination that will reduce my risk drastically, because derivatives as an instrument should result in reduction of my overall risk of the security. Right? So the hedge ratio is a very, very important aspect as far as the futures transactions are concerned, because my intention, or for that matter any derivative transaction is concerned, what is the hedge ratio? Because the major thing that we are losing out by getting into this transaction is I should be able to reduce the risk. If I go purely on the spot market, my risk is very high, 56 units. Now to what extent I can reduce the risk, chance of uncertainty, to what extent I can reduce it is what I am covering through the derivatives market. So which I have seen that it has gone down from 56 to 14 units. So even if I lose, my loss will not be that great. Probably what we'll also do is there are a few more measures of understanding this risk or loss. One powerful measure which is used in the industry today is called value at risk. So the VAR, typically a simplified name to it. So we can very well try to find out what is the VAR in both the cases. If I had unhedged it with derivatives versus I have hedged it with derivatives. I have unhedged by not taking into derivatives versus I have hedged it. What is happening to my VAR? What is the amount that is at risk for me? That amount that is at risk, if it comes down drastically, then I am in a safer position. So for a banks or any kind of companies, when I say risk management, it's nothing but they are trying to reduce that VAR to a drastic extent. So the amount that is at risk for them, which is uncertain for them, they are trying to reduce that amount which is exposed to uncertainty, which means almost trying to convert the uncertainty into a certainty. Because many of the transactions, let's say bank, it gives a lot of loans. There is a lot of uncertainty in the collection process. So to what extent I can convert that uncertainty into a certainty is what is the simple concept of risk management. So for that I should be able to measure the risk, and then only I should be able to manage it. So that is where we are talking of risk means through standard deviation. One powerful measure for a risk is a standard deviation. So the moment I am able to see if the standard deviation is very high, then it means the risk is very high. I should pull in some enormous measures to bring down the risk or the uncertainty. If the risk is much, much lesser, very small region, then it's not that superficially high for me. So I can still think of accepting that risk as it is. Right? So even if I lose, the loss will be pretty minimal. So let's leave it at this stage. There's no point in doing a risk mitigation anymore after this stage. So that is where probably you can take a decision on. Value at risk is the measurement itself in terms of dollars. how much can you lose on one single day? What is the maximum amount you can lose? Or what is out of every 100 days I take, what is the amount which is at risk 99% of the times or 95% of the time? Because see, one odd case you cannot avoid. Suddenly today something collapses, there is nothing much you can do. But at least 99% of the times you should be confident that you will not lose more than this. Which means on every 100 days, 99 days at least, I should not lose more than this number. If at all my loss occurs also, it should not be more than this number. Then at least the company is stable. The moment they are losing everything, one sudden day, they don't have any measure. This is where today lots of companies have winded off their business during this recent crash. Right? Even a few billion-dollar companies have gone bankrupt just because of the simple recent economic crash. So, which is because they did not hedge the risk properly. I'll tell you one more example. There is one of the biggest banks in Australia, National Australian Bank, which is like a number one bank of Australia. They started playing on the derivatives contracts, not as a hedging, but more as a speculation. It so happened that the exchange rate between the US dollar and the Australian dollar fell just by around 25 cents to 30 cents, not more than that. These guys went into a loss of $550 million. So you could see the volume of the transaction they have done. The fall in the price, fall in the exchange rate was just 25 to 30 cents, which is happening very frequently in India today. Rupee versus dollar, right? A 25 cents fall is by around probably 10 rupees, which we have been observing for quite some time. That small fall, the company has lost $550 million was the loss for that bank, because they did not use derivatives for hedging purpose. They thought they want to gain on it. They thought that the exchange rate will go up. So they want to benefit out of that exchange rate. Probably if it had gone up, they would have benefited by that same 25 cents on every transaction, and they would have made multi-millions. But because it has gone the other way, and they did not use a protection for that. Speculation is no protection. Just like your stock price investing. Think that the things will go in one direction and simply get into the transaction. So they have used the derivative exclusively for a speculation purpose, not for a hedging. Here in this case, hedging means I have one share and I am going for one futures. That's the hedging position. When I say speculation, I'll just go for a share market or I'll just go for the futures market, nothing else. That is what I am calling as a speculative position. If I am going with a speculative position, I may gain or I may lose. Right? So, in that scenario, the companies may completely go bankrupt if they don't hedge their positions properly. That is what the 2008 crisis has shown for almost all the biggest institutions, financial institutions, as well as the non-financial institutions in the world, that as long as the economy is in a boom, you are able to make multi-millions. But the moment the economy is in a crash, you have seen that you are going out of the business. Because most of them, they did not try to hedge their risk. So that's where today there is an enormous demand for the risk management profession. Whatever may be the kind of investment, every rupee of investment the company is looking at, they are trying to have a mechanism to hedge that risk. So they should have some mechanism to identify what is the risk if it is unhedged versus if it is hedged, by what extent I am able to reduce the risk. Is it going more into a comfort zone, or is it going is there not too much of a difference by getting into the risk. So the derivatives are really helping the company to reduce the risk to that extent. This is what we are seeing through this futures transactions also. The moment I am able to use this combination in the futures, at least for Infosys, it will reduce my risk drastically. The same logic probably you should try and apply on different securities where you will get different numbers. So as a practice for you, it's only download another data. Again, do the similar stuff. So the data today is available everywhere. Right? So on NSE, BSE, NCDEX, probably you do the same on gold price, gold in the current market versus gold futures. So I can do the same logic there also. So everywhere, wherever a futures market exists versus a spot market, we can do this kind of scenario where you can get into one transaction in the spot market and another transaction in the futures market, so that you can think of assured kind of returns. It may be very small returns, right? In the bank deposit also you are not getting anything enormous, but at least you are getting assured. So when you talk about a world of risk management, our focus is getting more in terms of assured returns rather than high returns, right? No one can give you high returns without a high risk. Probably when you say real estate industry is going to give me 30%, there's only some probability for that. It's not assured. Under XYZ terms and conditions, then only you will get 30%. But if someone is assuring that you will get 30% in real estate, all of us will jump only to that investment. That is where even some lot of frauds also occur. Someone initially they will assure that you will get a 15% return. You put in our chit fund, will give you 15% return. When they are promising much more than what a risk-free return can give, the biggest chance is they'll fly away with the money, because no one can give a very high assured return without any risk on your side. No investment can give you a guaranteed return which is much higher than the risk-free return. When someone says the stock market will give you 15% return, no one can assure that 15%. So probably there is a 50% chance that you will get 15% return. There is a 50% chance that you will lose 5%. Overall average is still the 7% itself. 7 or 8 or 10 itself. So no investment typically can give us an extraordinary return. So to be put in a very simplistic terms, the bank deposit is the much safer deposit. That's where even a biggest of the investors, they maintain a huge amount in terms of bank deposits. Even the biggest of the investors, let's say Warren Buffett, he does not put all money in the stock market. He still has a good proportion in the bank deposit. The reason being, one, it's a zero risk. The others, yeah, you may get a huge profit, but only with certain probability. The more and more you understand that market, the more and more you are willing to take the risk in that market, you can make much bigger out of it. Right? Again, it's as good as a job versus an entrepreneurial model. Job, whatever is, even if the amount is small, it's fixed. It's assured. Whereas the other side, you may think that you will get more. You may get, you may not get. There is a risk you are taking. So it's again like a equity market. It's more like the fixed income market versus a debt equity kind of a market. So almost all these, wherever there is a fluctuation, our intention should be to reduce that fluctuation by getting into some kind of a portfolio. This is actually a concept of portfolio management, where the portfolio I am creating using a stock and the derivative market, because we are more dealing with the derivatives now. I am trying to create a portfolio of the stock market versus the derivatives market of the Infosys security. You can do the same thing with any other or every other security also.